Every nation claims to be sovereign. Every government claims to control its own money. But there is one financial product so powerful that nearly every country on earth owns it, whether they want to or not: US Treasury Bonds. They don't promise innovation. They don't offer high returns. And yet, trillions of dollars flow into them year after year. Why would rivals, competitors, and even enemies of the United States all buy the same debt issued by Washington? The mystery isn't why America sells so much debt. The real mystery is why the world keeps buying it, especially when the risks are obvious. To understand this, we need to go back to how the global financial system was designed. The origins, when safety became power. After World War II, the global economy was broken. Europe was devastated, Asia was rebuilding, and trust between nations was fragile. Out of this chaos came a new system. The United States, holding most of the world's gold and industrial capacity, positioned the dollar at the center of global trade under the Bretton Woods system. Currencies were tied to the dollar, and the dollar was tied to gold. U.S. government debt became something new. Not just a loan to America, but the foundation of global financial stability. Treasury bonds weren't just safe, they were predictable, liquid, and backed by the strongest economy in the world. Even after the gold standard ended in the 1970s, one key habit remained: global trade was still settled in dollars. And that habit would change everything. The rise. How trade forced demand as globalization accelerated. Countries exporting goods, especially oil, manufacturing, and commodities, were paid in dollars. Those dollars had to go somewhere. Holding large amounts of cash was inefficient and risky. Local currencies couldn't absorb that scale. Gold was limited and illiquid. US Treasury bonds solved all three problems at once. They were highly liquid, deeply trusted, easily tradable at massive scale. Over time, buying treasuries stopped being a choice and became a requirement. If you ran a central bank and wanted to stabilize your currency, park foreign reserves, signal financial credibility, you bought US government debt. This demand grew so strong that US Treasuries became the collateral of the global system used in banking, trade finance, and derivatives markets worldwide. The breaking point. When debt exploded for decades, this arrangement looked unbreakable. But as US deficits expanded, the volume of Treasury bonds exploded. What was once a symbol of discipline slowly became a symbol of dependency. The world needed treasuries to function, but the supply was now tied to America's growing debt problem. After 2008, and especially after 2020, issuance accelerated at historic speed. Trillions in new bonds entered the system. Interest rates were suppressed. Central banks absorbed massive quantities. This created a contradiction. The more debt America issued, the more the world depended on it. The more the world depended on it, the harder it became to stop issuing debt. Treasuries were no longer just safe assets. They were systemically unavoidable. The fallout. Forced buyers, silent risks. Today, many countries privately acknowledge the risk. Holding U.S. debt exposes them to inflation, erosion, political leverage, sanctions, and asset freezes, currency depreciation. But selling treasuries at scale creates its own dangers. If a major holder exits too quickly, bond prices fall, global interest rates spike, domestic currencies destabilize. So countries remain trapped in a loop. They complain, but they keep buying. Not because treasuries are perfect, but because there is no replacement large enough to take their place. No other bond market offers the same depth, liquidity, and global acceptance. Failed fixes. Why escaping is so hard? Many alternatives have been proposed. Gold lacks liquidity. Other currencies lack trust. Digital assets lack stability at sovereign scale. Even attempts to trade outside the dollar system often circle back indirectly through intermediaries still holding treasuries. Regional currency blocs struggle with coordination. Multilateral reserve systems lack enforcement. Every exit strategy runs into the same problem. The global system was built around US debt, not despite it. Trying to replace treasuries is like trying to replace the foundation of a skyscraper while people are still living inside. Modern parallels. History repeating quietly. History shows this pattern clearly. When Britain was the global financial center, its debt served a similar role. Countries held it not out of loyalty, but necessity. As Britain weakened, the system didn't collapse overnight. It slowly shifted, reserve by reserve, crisis by crisis. The same questions are now being asked about the United States. Not will treasuries fail tomorrow? But how long can forced demand hold together a stressed system? The danger isn't panic selling. It's slow confidence erosion. 3 takeaways. First, US Treasury bonds are not just investments. They are infrastructure. The global economy relies on them, whether it admits it or not. Second, countries buy treasuries less out of trust and more out of lack of alternatives. That distinction matters. Third, systems built on obligation rather than choice eventually face pressure. Not collapse but gradual rebalancing. Final thought, the most powerful products in history are not the ones people love. They're the ones people can't avoid. US Treasury bonds don't dominate because they flawless, but because the world hasn't figured out how to live without them. If you want more deep analysis on global power, financial systems, and the hidden mechanics shaping the future, subscribe to the channel. Because the next chapter of this story won't be written in headlines, it will be written in balance sheets.